2020 was marked by the largest year of aggregate net absorption that we've seen in the marketplace for Salt Lake County, for Utah County, and for Weber and Davis counties. Salt Lake County net absorption was roughly 5.8 million square feet, which was a banner year. And so I think the comment regarding acceleration of our market is spot on, and a lot of that was actually driven by pandemic factors and just kind of seismic shifts in supply chain. If you look at weighted averages, which a lot of the graphs are based upon, don't exactly tell the entirety of the story. Virtually across every segment of the marketplace and irrespective of product class, we've seen wholesale increases in lease rates from 3 to 7.5% from Class C to Class A year over year. That's primarily been in the bulk distribution segment, so our net achieved average lease rate and first-year lease rates are showing as lower this calendar year, but that's not reflective of what's actually happened by individual product type. It's the average size of the deals that have inked have grown considerably, and that's really because of the emerging role of Utah in supply chain. Because of our regional distribution footprint, we hit about a 65 million person trade area from a 1 to 2 day drive time perspective, which is kind of the metric at which most of the super regional distribution looks at. And then with our manufacturing base, we've seen growth in virtually every segment of the industrial market. Everybody's probably heard me say this before, but kind of the outlier factor for the Utah market versus really any other market in the United States is that 40% of our base is manufacturing, and that, not exactly 40%, but approximately 40%, and that is growing at pace with the base. So for every net square foot that is leased and or purchased, 40% of that occupancy is going to be in subsegment of manufacturing, from large scale like injection molding, plastics, thermal forming, those types of uses, all the way through small part, high dollar volume tech pieces in the defense and aerospace segment, through medical device. So it's really across the whole spectrum of manufacturing users, and that's one of the things that really insulates our industrial market and has historically insulated it since about 2001, when the prior Governor Huntsman instituted the cluster initiative. There was a concerted effort to really diversify the manufacturing base. 20 years ago, if Kennecott had a recession, the state of Utah had a recession. If Geneva Steel had a problem, then Utah County had a recession. That's not the case today. We've got one of the broadest and most diverse economies, industrial economies in the nation. It supports occupancy across all segments of the marketplace, from e-commerce to direct store fulfillment, omnichannel logistics, and then the manufacturing component, and then just regional sales and service types of uses for supply chain support for a lot of those manufacturing operations. We've seen close to 9 million square feet of inventory delivered in just Salt Lake County alone in the last calendar year, which is about 2 million square feet more than we've ever seen on record net absorption numbers. And you've seen no true appreciable increase in vacancy. When you're looking at trailing 2020 vacancy, you have some deliveries that occurred just prior to the end of the year, so they're being counted in those numbers and they're reflected in the numbers. I fully expect that number to decrease by about as much as 40% by the end of first quarter, with deals that are in process, out for signature, in negotiation now currently. We're tracking close to 11 million square feet of market activity, tenants in the market, users in the market, which was in excess by about 1 million square feet of what we were tracking coming into calendar year 2020. So assuming that there isn't some major seismic shift in the national economy or something that happens from a policy perspective that changes the way that industrial space is consumed and used, it's a trend we just expect to continue. Beginning of this calendar year, and I'm going to use Class A transactions of scale as really kind of the bellwether indicator of where the market's going. But it's really happened across all segments. The stuff that's smaller in scale, that's more conducive to a family office or a 1031 buyer, versus the stuff that's institutional, has compressed almost across the board 100 to 125 basis points in 12 months. It is unbelievable. I, and I'm sure all of my colleagues, are talking on the phone 15 to 20 hours a week with external capital trying to enter the market. We have to often disabuse people of the notion that Utah is still a value market other than from a price per pound basis and from a runway perspective. We've finally crossed the point of land constraint in Utah, where we have, if we see consistent deliveries, if I go back 10 years and pick up the the average of net absorption over those 10 years. So I'm picking up 4 years of the worst part of the recession. Statistical bottom of our market was Q3 of 2011. We have seen a just continued steady consumption of ground. So you take a 10-year trailing average, we've got about a 7-year supply of remaining ground in the market, and that's with everything that's entitled, even if it's not served with infrastructure. If you clip out some of the things that still require some spine infrastructure to be developable and take the last trailing 5 years of net absorption, we've got about a 5-year supply. You have that in conjunction with what you mentioned before, the increase in construction costs that are still rolling at double-digit pace increases every year. Land prices in our Northwest Quadrant core, in the I-15 Sono corridor, have almost doubled in price in a 2-year period. We were seeing trades for improved industrial ground, really of any size, in the $5.50 to $6 a square foot range entering last calendar year, and we'll see trades that are north of $13 a square foot for similar product. So if you think about it on a FAR basis, your typical 35-40% coverage ratio of a building, you're going to be close to $30 a square foot under building, with construction costs that have continued to increase, and even with compression in cap rates, yields are going down, which means that investors, developers are willing to accept a lesser rate of return just to have an entry and a footprint in our market. Again, it's sometimes difficult to look at what is shown as the average cap rate in the market, because that's across every product type in the industrial segment. There is a huge differentiation between that which is considered core and core plus assets. Those are trading from 4 to 4.3 entry yields and are producing single-digit unlevered IRRs with low double teens IRRs, which is the target for the majority of the institutions that are looking here. We're now trailing California by about 25 bips, which is a record. Historically, that's been anywhere from 100 to 175 basis points, and we're now in a segment of the market, and with the amount of interest in Utah because of all of the fundamentals, that are commanding record cap rates that are on par with most West Coast markets, and that's really driven by asset aggregation. So, a deal in Utah that trades at a 4.43 cap is going to produce a price per pound in the bulk or medium distribution space. It's going to be $120 to $140 a square foot. You compare that basis to yield that is in a lot of the other western coastal markets, and if it's an asset aggregator that's going to build a portfolio and sell at an enterprise level, what that's doing is dragging up the averages across, dragging down the averages across the board in terms of price per pound. So you get yield with a rent growth thesis in our market that is not appreciably increasing the portfolio yield, but it does weight down one of the core metrics that investors look at, which is price per pound.
We're fortunate in Salt Lake City to have entrepreneurial, well-capitalized developers that are local for the most part, that can react to market conditions quite quickly. And with some of the larger land developments that we've seen lately, the market will continue to meet demand. I've been in the market for 25 years, and I don't believe there's ever been a moment in that 25-year history where I can recall us getting to a point where the market did not respond quickly enough to meet the demand. I'll use an example. In 2011, a client of mine analyzed the data coming out of the 2008 downturn, and we were the first market in the country to build a spec building. And I think with the entrepreneurial spirit, we will continue to be ahead of the curve when it comes to meeting demand in the marketplace.
I feel like we have a very responsible real estate community in Utah, and that consists of some of the greatest professionals, both local, everybody knows most larger institutional national groups are here, but we have a very responsible and I would say equally as responsive of a group. And they're very keyed in onto the market dynamics. And I would say that in addition to just their pulse on the market, this is also a group that has their pulse on the industry and how it's changing. And so I do think that we are positioned well moving into the future. And you know, as you take a look back historically, as we track vacancy, you know, this trend that we talk about with this real estate community has shown forth for a number of years. But not just in tracking, you know, the pulse of the market, but also in tracking the pulse of industry trends. So I think we'll see this year buildings that are going to be eclipsing 40-foot clear on the interior of some of these big warehouses. I think we have a couple of buildings that'll break the 1 million square foot mark this year that'll be built on spec. I think some of those already have tenants in place. And so I think we're positioned very well. I think this vacancy is not new. It's been kicking around in the 2.5% to 3.5% range for the last 8 or 9, maybe 10 years. And so again, that speaks to the responsible nature of what I would call our real estate development community.
I believe the Northwest Quadrant is going to be the center point for development for at least the next 10 to 15 years. As an example, the Global Logistics Center, which is a 3,000-acre development, has at least a 10 to 15-year supply of land. And if you look south of 80, there's at least a 5-year, maybe 7-year supply of land. And then there'll be emerging development sites that we know will be coming in the next 5-year horizon. So I believe the 80 corridor, north and south, adjacent to the Salt Lake International Airport, will be the future. And I do believe some outlying areas like Tooele, potentially further north, will have their place. But I do believe that the historical corridor along 80 will be the future of Salt Lake.
It's a really great question, and I think for people that understand the industrial market, I think there might be a perception that the Northwest Quadrant, you know, there are a few opportunities out there, but we still have, and we're going to still see lots of activity and development in the Northwest Quadrant. I think there are some large stakeholders that control the bulk of that inventory out there, but we still have a runway in the Northwest Quadrant for sure. We are seeing an evolution of land values again as they continue to creep up. And you know, we've seen offers on industrial dirt as much as $17 a foot on bulk pieces. And so the Northwest Quadrant is still going to have a place in our, you know, in our little micro world here. And but we are seeing definitely a convergence of what I would say a blending of 4 counties and maybe even 5 counties. You know, spanning all the way up into Box Elder down to, I would say, Spanish Fork, Payson markets. And this is not just a local representation of users. This is regional and national. We see some big names entering those marketplaces, and I think that's very, you know, I think that's going to become more and more commonplace. Big national groups that are targeting those markets as well. A big draw, and I think connected to the industrial segment of the market, is residential. And we know that some of these markets are in the very near future going to outpace Salt Lake County from a population standpoint. And so we'll continue to see this market span from, you know, what now I would say is probably a 90-mile, maybe a 100-mile span across the Wasatch Front, encompassing all of those counties.
So you have to think about supply chain not as a static thing, but as kind of a living, breathing organism. It's a reactive rather than a proactive segment of the business. I think the people that have the hardest job in America right now are supply chain engineers, and and supply chain officers within companies. Most C-suites now have a supply chain officer, and we're seeing the presidents of corporations now come out of the supply chain side of the house rather than procurement or sales or finance, which is, prior to the last 5 or 7 years, kind of unheard of. The supply chain wonks were kind of locked in their own little closet somewhere, and they got an hour or so to get out and breathe air before they went back into solitary. That is not the case anymore. I think probably the biggest trend that's going to affect supply chain is the recognition that our market has to move from a just-in-time to a just-in-case inventory model. That is really primarily driven by the fact that we saw shortages in virtually every segment of consumer products, medical device, PPE, all across the spectrum, basic food items. And that recognition that supply chain can't sustain this type of seismic event that happened in our country, across the world, in a go-forward mode. And that recognition was happening. We've had ever-increasing natural disasters over the last 10, 11 years that are huge upsets to supply chain. When you have a hurricane in the southeast and FEMA comes in, they consume all the trailer traffic in the market for long-haul trucking. That causes freight rates to go up, and then it instantaneously changes the calculus of where do you put a distribution node, where are you sourcing from, et cetera. You have the wildfires in California that affected it. You have union strikes that happen in ports, things of that nature, and a lot of regulation that affects it. So I think the impact of the new administration on whether it's emissions or further regulation by the NTSB will have a pretty significant impact on how supply chain engineers are calculating their distribution nodes. And I think you'll continue to see supply chain optimization, which I mentioned last year in my panel, as kind of the term du jour, as everybody's looking to find efficiency wherever they can find it. And it's hard to find in a market that, look at the industrial market all across the country is on fire. Utah is one of those that, because it's supply constrained, has a tremendous amount of attention. But it's still a value market, relatively speaking, compared to some of the other markets for labor and for transportation cost. And we don't have many of the regulatory issues here that you have in some of the coastal states. So I think I and all my colleagues would attest that we're seeing a huge influx of companies that are just unable to function with the regulatory environment and labor environment oversight that takes place in states like California and Washington. And that's a trend we don't see reversing, probably accelerating, if anything. And the more density of supply chain users that you have in a given market, it just creates a base that feeds on itself and continues further growth. So Utah is in many ways a standalone economy in its ability to feed itself from end-to-end supply chain, from base manufacturing, raw materials, all the way through packaging, distribution, and fulfillment. And there's a huge amount of third-party manufacturing capability here with all of the nutraceutical and health and beauty product in North Utah County, through aerospace, defense, carbon fiber, composites, medical device, you name it, it's here. And then obviously Amazon, who I'm sure my friend Tom will talk about in length, has continued its march, but as a kind of bellwether indicator that many are looking at for the health of an industrial market, Amazon was less than 25% of our absorption. So while an extremely meaningful part, if you annex that out of the equation, we're consuming as much space, more space on a year-over-year basis every year for the last 5 years than we did prior to Amazon starting to make its big push, which is very indicative of the health of the market.
I believe it's net neutral. If anything, it will increase the demand. Automation doesn't decrease the footprint. I think if anything, the efficiency will lead to increased demand for manufacturing. So, but I do not think it will decrease footprint, nor will I think it will decrease the need for labor. I think if anything, automation will make us more efficient as an economy, make more efficient manufacturing practices, and therefore increase industrial requirements.
Yeah, I mean, look, I think as we focus on wages and we focus on job creation and you think about automation, I think oftentimes people think those things are in conflict. And I don't think automation just exists, as we know, not just in the manufacturing segment of the marketplace, but it's a big part of the industrial market as a whole. But I don't think that automation necessarily means a reduction in labor, and I don't think it necessarily means a reduction in square footage. One of the largest users, occupiers that we represent and have had a very good relationship with, their first footprint in our market was an 800 and almost a 900,000 square foot building, but 2.5 million square feet under roof because of automation. But they still employ upwards of 4,000 people, I think consistently about 2,500 to 2,800 people, and good wages. And so I don't know that automation necessarily means, a negative impact to labor or a shrinking of footprint. I think in some cases, manufacturing specifically, you might see a consolidation because of automation, but I wouldn't say that's the norm. I think that in general, I think the automation is going to make the industrial segment healthier.
I don't think there's any question that industrial will be the backbone of the future. How it impacts the office market, I think that's really hard to determine. I think it will drive some office growth specific to industrial demand. For example, I believe that automation will increase, and that will drive a small amount of office requirements. But I think driving downtown or suburban office is really hard to determine. I think what we'll see moving forward are larger office requirements within the industrial buildings. Manufacturing, tech, bioscience, those types of requirements will have increased office demand, but within the industrial footprint.
Most healthy relationships, it takes two components or more, and I think most people that understand this marketplace understand that, and this is in a lot of real estate publications, Utah, and not just real estate, but business publications, that Utah has been identified as, from an economic standpoint, one of the most diverse and stable economies in the country. And it's not made up from just one strong sector. So I think it takes, multiple sectors to really hit the mark as we have done, and again, very attributable to the leadership of our state and our private sector. And so I think the industrial sector is and has been for a long time a very stabilizing force for our local economy. People that understand the industrial sector understand that 40% of it is manufacturing. And we're continuing to see a surge of manufacturing in the industrial markets. And we're gonna, I think, whether it's life science, biotech, tech industries as a whole, I think there is a place where the industrial world is kind of creeping into the office world in some regard. We're seeing a lot of these big names that are taking warehouse space, converting a big portion of that into corporate office or some type of a back office element. There's been some of our development partners that have been, putting office users in 100,000 square foot warehouse buildings for a number of years now. And so, but I do think it's a healthy balance. I do, and I don't think that as has been interpreted, I don't think we're going to see industrial take over office like what may have been interpreted of the takeover of retail, if you will. I think that office is going to continue to have a place. I think we're going to continue to see a very healthy office market, both here in the CBD as well as peripheral markets. But I do think it is definitely one of the legs of the stool that makes this a very healthy, vibrant market. And I think we're going to continue to see. I think it was just last year that you heard me say industrial, it's not just the new sexy, but it's been the sexy for a really, really long time. And I don't think it's going away. I think, you know, there's a lot of sectors of the industrial market that make it a very healthy market.
That's a good question. I think those of us that have been in this for multiple cycles have seen circumstances where we saw occupancy and vacancy added to the base be pretty elastic, and that creates some pretty big gaps that have had major influence on rent. I don't think we're at that place anymore. We've really hit that, again, tipping point of both scale and land constraint with all of the attendant supply chain factors that follow it, to really continue both organic growth, which is about half of our market activity, and then external inbound growth, people coming from other states, again, whether it's fleeing regulatory environments or otherwise. So in the past, when we've seen this type of demand or pent-up demand, we've seen the market overbuild itself, and it was during those time periods you had still 10, 15 years of remaining land supply. So you get to a point of overbuilding, market corrects, there's something systemically that happens in the economy, because it's not usually Utah that is, you know, leading that kind of recessionary pressure. So people were able to go out and then buy value land positions, build at a construction basis that was 10, 15, 20% less. Now they can deliver a deal for a lower rate at the same yield, and everybody has to correct. I don't think those times are here anymore, specifically because of the land constraint, and you have a very significant artificial buoy for construction prices in Utah, because of all of the municipal projects that are going on. You know, depending on whose stats you read, 10 to 12 billion of municipal, university, institutional with prison, airport, other types of projects that aren't going to sunset. And with where we are in the cycle of the pandemic, you would think, you know, forward-looking 12, 18 months, you'd see some softening for demand, and it's just the opposite. I think probably the most key component of all of it is the largest supply chain shift and consumer shift in human history has been the advent of e-commerce, right? I talked about that in 2013. I think the pandemic has only accelerated that. There are a lot of people, particularly the generation that was before me and the generation before that, that found kind of shopping as a social experience or an opportunity to get out and go interact with people, and they've not had the ability to do that. So it's forced people to adopt a model that they were very resistant to adopting. And once they found the ease of consumption, in a world where time is the only commodity we have, I think you've seen a wholesale adoption of e-commerce by a section of the economy that will probably not be 100% reliant on it, but it will maintain some reliance on it going into the future. So what would have been kind of a steady curve of growth, I think had a huge boost and is now going to continue to have a steady period of growth. Especially as your Gen X, Gen Y people get into the age of consumption. As they enter the workforce, it's a completely different headspace that they operate in. People live their lives on their phones, and you can do everything from there. And that was, that's not the way that we grew up. So I don't think we fully understand or can frame or encapsulate how that's going to have an impact long term, but I know it's going to have a positive impact on the base.